The time for community banks and credit unions to win is now. While the big players and exciting new challenges grab headlines, regional institutions are at the heart of the banking ecosystem, putting the service back into financial services. Serving their local communities, these organisations around the world have a unique advantage over their competitors. They have deep, established roots with their customers. They offer a local, personal service, and they're not tangled up in the legacy tech mess that the big banks are. To read, watch, and listen to what else we've got to say about them and how they can win, visit 11fs.com/communitybanks. That's 11fs.com/communitybanks.
Hello and welcome to Fintech Insider Insights. I'm David Brear, CEO here at 11FS. Now, you might remember last year we discussed how not to build a bank. We'll put these links in the episodes for you to catch up with and the report that we did on that as well. Today what we're going to be doing is bringing you a new two-part insight special on how to buy a bank. We have already seen the headlines on both sides of the ponds this year. In the UK, Nationwide have bid $2.9 billion to take over Virgin Money, while in the US, Capital One hope to acquire Discover in a deal worth over $35 billion. Fintech funding might be going down a little bit all over the world, but big money M&A is here to stay. So in this episode, what we want to do is take a closer look at why and how banks actually make this thing happen. What reasons do banks buy and sell? What really are the processes and how long does it take? I imagine it's not quite as easy as just buying something off Amazon. But after all is said and done, how does this actually impact the customer? To have this conversation, I'm joined by some amazing guests who have really seen for themselves actually how these things happen or seen mergers and acquisitions really up close and personal. Firstly, I'm delighted to be welcomed by Virginia Varela, who is Community Bank CEO and former federal regulator. Welcome to the show. How are you doing?
I'm doing fine. Great to be here.
Yeah, well, you will have seen this one, I guess, from a few different angles in terms of being within the regulator, being within an organization, sort of adhering to those regulations. It's an interesting topic. But for anybody who doesn't know you, tell us a little bit more about your background and why you're interested in it.
Well, thank you for asking. I love this topic. It's fascinating because it's a really pivotal point in an organization's life. And I have an unusual background. I'm a former regulator. So I started my career with the Federal Home Loan Bank of San Francisco as an examiner and then moved into policy and supervision, worked for the Office of Thrift Supervision when the savings and loan crisis hit, was merged into the OCC and later was a Fed regulator. But I've done everything from heading up the applications department and seeing a lot of mergers to being an examiner and overseeing the examination department with a lot of different boards of directors, seeing how they interact and make decisions. And then also looking at policy related to merger and acquisition activity, the application process, and really enjoyed that part of my career, retired, and then moved into the private side. So I've been kind of a turnaround specialist. So I started as a risk officer and moved into the president CEO role, been at 4 different banks. And my role was really to get them in a strategy where they could move forward, get them ready for sale. And all 4 of those banks were ultimately sold. In my earlier career as a regulator, I was also part of the management consignment program where we would go into banks and, manage it as needed or look at FDIC assisted sales. So I've had that experience. Then when I went into the private industry, really with some of these small troubled banks, you're really wanting to set them straight, but always have in mind an exit strategy. So my most recent gig, which I'm still a part of right now, is with Golden Pacific Bank Corp., which was ultimately acquired by SoFi to become SoFi Bank. And that acquisition took place, was finalized in February of 2022. So I've had an amazing career, sort of like a Forrest Gump of banking. I've done a lot of different things. So,
I love that. Forrest Gump of banking. I'm going to avoid the impression immediately, but no,
good.
that's a
Yeah.
great. I nearly, I was that close. Like I really was that close. But
Hopefully a few more brains, but I'm talking about the luck.
yeah, I
The
mean,
luck
he
and
got
the
some amazing stuff
experiences.
done. Yeah, do you know what I've said in my career a little bit? It's sometimes having the luck to be in the right place at the right time, sometimes, and then
That's
recognizing
right.
opportunities, isn't it? But in amongst those crises or in amongst the changes that you've seen in those regulations, I always love it when the producers do a great job and bring on great people, which is good. But all right, well, thank you very much for coming. We'll pick your brains more and more on that, and actually, we should introduce our other guests as well. Paulo Rocha, who is the reporter at American Banker. Paulo, I always hate it when I go second introducing myself after Jason at our place because I'm like, oh, what do I? But like, give everybody a bit of an introduction to you, and obviously for our international audience, what American Banker do.
Yeah. To be fair, that's quite an extensive background that Virginia brings. I'm a reporter over at American Banker. Been covering financial stuff for 7 or so years. We are a mostly online publication with kind of monthly magazine. We cover the ins and outs of the banking industry. Whether that be the tech side of things, whether that be community banks, big and regional banks. I personally cover kind of the big and regional banks in the country. And then, we've got a really strong policy team that covers, the ins and outs of what's happening in DC. I'm based in DC, so I kind of follow some of that. But, I think where I kind of try to focus is more, the bank earnings reports and really kind of the business of banking and, this M&A topic that we're talking about today.
Very good. Well, it's fantastic to have both of you on. I think we should probably get into it pretty quickly just because there's a lot to cover. Maybe if we start a little bit with why do banks buy each other or why do banks buy banks? I mean, it's sort of an industry that's no stranger to this, really. The sort of heady days of, pirates of the high seas and, mergers and acquisitions as way to expand from a geographical perspective. I mean, Virginia, you talk about, community banks, actually community banks getting out of a state into other states and, buying regulatory, oversight. I mean, there's lots of different reasons, but maybe Paulo, starting with you, why do banks do this? Why would they acquire?
I think really the biggest reason, and, I feel like this has been the case for decades, is just, kind of keep up with technology. I think, maybe 20, 30 years ago, actually earlier in that, it's money market funds were competing for bank deposits and, maybe banks kind of needed to, find other ways to kind of keep up and with customers' needs. These days, it's kind of the same argument. I think a lot of fintech companies have these very nifty products that offer all sorts of new services to people, and I think technically run on the banking rails. But if I'm a big bank, I need to compete with those newer, flashier fintech companies, right? And I need to invest, in my technology capabilities. I need to build an app and with kind of the right bells and whistles and keep it updated so it does not look stale in 2 years. And you got to invest in cybersecurity, you got to invest in all sorts of things, and that's expensive. So buying a bank and kind of combining forces, two banks can spend maybe even the same amount of money and have more power. And then if I'm a community bank, which, there's, 4,000 or more of those in the country, I'm competing with the big banks that are rolling out all these tools, right? So you just, I think it's just a need to stay relevant, a need to, keep serving your communities, a need to make sure your customers can keep turning to you. So, just joining forces, I think is really the most powerful way of doing that and make sure that your spending can go a longer way.
I don't want to be the guy putting the skeptical hat on straight away, but having worked in banking for quite some time, I mean, most businesses or most banks bought, I would say, to acquire market share, but the ROI often gets forgotten pretty quickly. I don't know about you, Virginia, but what's your experience on that? Is it a market grab, as in how can we accelerate the piece? And actually, I mean, do you see the ROI being met from those things?
Well, it's interesting that you say that because every bank will have their own reasons for wanting to acquire or be acquired. And a lot of it is economies of scale. I agree with Polo that, a lot of it will be innovation and trying to stay relevant, but it's also economies of scale. So you're looking at the needs today for a bank or a fintech that buys a bank. They're going to have huge compliance needs, and you don't want to duplicate that if you have to. They're going to want to have combined capital. There could be products. You mentioned, David, geographic location. So you might want to move into different geographies, but today with technology, it is about different products and service lines. So you might want to grab a different product and service lines. Nowadays, we have in the United States, we have credit unions buying banks. And a lot of times, they may want to buy because let's say they just want to start small business lending. Traditionally, credit unions could not do small business lending. Now they can. So they might want to purchase a bank that does small business lending. So there's a lot of different reasons. And as far as the ROI, sometimes it works, sometimes it doesn't. And it's an interesting thing to see why it doesn't. I have some opinions or observations about why the ROI does not go up. But generally, it technically and on paper, it you want to acquire a bank and you want to look at an acquisition to result in a better ROI place. But I want to make one other point, and that's that we were talking about why banks want to acquire another bank. Regional banks, small community banks, credit unions, a lot of different fintechs. A lot of them want to buy a bank for things like, access to liquidity or economies of scale. But I would argue that money center banks, they may want to acquire, but they don't want to necessarily be acquired. They don't need to. So it really depends on who you are as a bank, what your brand recognition is, where you are. You don't. I thought Capital One and Discover were kind of interesting because they both are doing well. But, they might wanna for them, it could be just a combination and of, profiles, and they're getting the economies of scale. But I don't see a lot of the really large money center banks wanting to merge together. I don't know if you have other thoughts, but that's just an observation I've seen.
Yeah, what do you think with that, Paulo?
Yeah, I mean, I think, particularly the biggest ones, they legally can't really do more acquisitions without, kind of getting, I think it's like 10% of the deposits in the country. I think if you go over that, you just can't go over that, right? So the major ones, JP Morgan, Bank of America, Wells, they just physically cannot do that without tripping up major problems. Unless, of course, there's a crisis and JP Morgan comes in and swoops to the rescue and buys First Republic out of failure. Then that's kind of the only way that a big bank can do. But, if you think about like a PNC, it's a pretty hefty bank. It's definitely no JP Morgan, no Wells Fargo. They've done some deals to get bigger and they can definitely do those acquisitions. But I think it's getting a little bit tougher with the Biden administration to do those kind of big deals. They're still getting approved in some ways, but, they're taking longer. You just have to, I think, meet a higher bar. So I think there is more skepticism among the banks that can acquire and are kind of big, but not massive. But I think what those bankers would argue is, in the meantime, JP Morgan, Bank of America, Wells Fargo are pretty big, and we need to combine forces so that we can better compete with them. And regulators in DC are allowing that, but certainly making it tougher to do so. And there's other reasons why the banks aren't acquiring right now, the business environment. But I think it's just a tougher environment if you're a regional bank that wants to merge.
Yeah, and I'd say that's sort of echoed globally as well. I'd say, exactly as you say, the only real movement at the top level is when there's some sort of systemic risk happening in the market. NatWest being encouraged to acquire a bunch of things, or Lloyds Banking Group being and then actually we can see. I mean, even most recently UBS with Credit Suisse, right? That was a major problem if somebody didn't swoop in. Silicon Valley Bank with HSBC here and all around the world as well, right? So if they didn't do that, then the broader system would be in a problem. But I guess, having seen that movie play out, they typically end up having to shed part of that organization because they are too dominant in the market in that sense. I mean, is a shifting part of this landscape that this isn't just something, and Virginia, you touched on this a little bit, but this isn't just big banks buying small banks. Actually, we talk about the broad banking battlefield. We're talking about, we're seeing Apple buy fintechs in the UK. We're seeing fintechs buying, you talk about SoFi. SoFi's a, scaled up fintech, right? SoFi buying, other financial institutions. Is this a different type of mergers and acquisition dynamic here? Because to your point, Polo, actually, this isn't just a how do we get bigger and, just keep blowing more air into the balloon. In some instances, it could be strategic with regards to technology assets or anything across that. So, Paulo, maybe you start with that one.
Yeah, no, I think that's a good point. And, I think as it relates to fintechs wanting to buy banks, there's kind of new acquirers or new interested acquirers. I don't know that the regulatory landscape is necessarily all that friendly to that these days. It might be, and some fintechs just haven't given it a shot like SoFi did. But, I think you really, during this period of high interest rates, I think we've seen the benefits of, say SoFi having a bank charter, right? Because banks have access to core, cheaper deposits. And so they don't need to, when they make a loan, they can use the deposits to fund those loans. They don't need to go out and, sell those loans to investors that are facing higher interest rates and maybe don't want to buy those loans from fintechs as much as I used to. I'll admit fintech lending is not a sector I cover that heavily, but I think it's been like a major constraint on growth for these fintechs whose models work great when interest rates were low. But now, everyone's a little bit choosier on what kind of risks you want to bring on, what kind of investments you want to make, and for higher rates reasons, but also, the economy is, so far it's doing great, but certainly there's been a lot of question marks for the last couple of years. So I think there's certainly an argument still for fintechs to acquire banks, but whether that kind of thing can happen in this environment, I'm really not sure.
Yeah. Well, what do you think, Virginia? Is it a different market now? Have we got different players doing the acquisitions than we did before?
I think there are a lot of changes in the marketplace, and like Polo said, there's differences in the administration and the requirements from the regulators. But I would argue too that the whole market is changing in a way that makes it difficult to acquire. So I still think there's a lot of fintechs out there that want to acquire a bank for the benefits of access to liquidity, low cost of funding, the ability to hold loans and credits in your portfolio rather than resell them. You don't have brokered funds, brokered deposits. I mean, there's just a whole lot of reasons why it works. And David, you were talking about economies and, maybe the ROI. But actually, when you become a bank, you all of a sudden have to hire new compliance people, risk people, regulatory issues. So there's really a price point on the cost of a merger and a cost of aggregation. And you have to look at that price point for every bank merger. So I would argue that fintechs are not acquiring banks for a few reasons besides just the regulators, and that's that they don't have capital. They don't have access to capital they used to have. The market's changed. You cannot go out and raise the funds that you used to just, let's say in 2020, 2021, 2022. You don't have SPACs anymore. I mean, the world has changed there. The other thing is that I would say I think there's a realization about the costs that come with banks, the regulatory costs. Right now, I think I read an article, it's probably in the American Banker, that there's more enforcement being issued against banks that engage in partnerships with fintechs because they're looking at the banks to regulate the BSA and other compliance regulations. So there's a cost to being a bank because you really become like, the police dog in the financial services world because you are more heavily regulated, but you also get insurance of accounts, which I think in the United States, most people understand that there's most customers will say, I want to put my money in up to a certain amount to make sure it's insured. So I would say that there's a lot of different reasons why today's marketplace is more difficult. Another thing is the world's changing. I mean, I used to do a little bit of consulting work, and I had a lot of cryptocurrency organizations that wanted to buy a bank. You had all these cannabis outfits that wanted to buy a bank. So I'm old enough to see that there's trends in acquisitions, and you don't really see that anymore. I don't see a lot of the crypto world. It's dried up as far as wanting to buy a bank. So there's marketplace changes that don't have to do really so much with the regulatory application process.
Yeah, I think a lot of sort of decided potentially sort of getting into banking and buying a bank are quite separate things in that process, aren't they? But so I guess we talk about it in the abstract, but what are the practicalities of this look like then, Virginia, in terms of if somebody wants to get into buying a bank? I mean, I guess it's like anything. It's like a marriage. It's like everything starts with good intentions, right? But not everybody can buy a bank, right?
hmm Well, I used to look at bank partnerships as something like dating. So you have like a blind date and you go in there and you're looking for red flags and doing your due diligence and deciding, am I going to go to the next step? Am I going to go on another date? What am I going to do? And then later on, is this marriage material? So, it's a whole process, but I will say that when you look at the application process and the acquisition process, it starts very early on. So if you're a CEO and you're at a mid-sized bank, small bank, mid-sized, larger, you're always going to want to have in the back of your mind an exit strategy or a consideration of the stakeholders. To me, the shareholder value is extremely important. And if I'm ethical and want to do the best thing by the ownership, I'm going to look for an exit strategy that will bring them out whole or much better. That's my goal. That's my role as a CEO or as a director. So always you're looking at opportunities. Now, for myself, I will say that fortunately I had boards and myself as a CEO, I was willing to think outside the box. So I was willing to talk to a credit union. I was willing to talk to, fintechs and get a better deal. Where I think there is some traditional mindset in the banking world where, unless it's a very traditional, I don't want to say white male, but you know, I just did. Unless it's a traditional bank to bank deal, it's like, I don't want to think about it and how much do I get paid personally kind of thing. So there's a mindset that goes in the beginning of having a board and a CEO that, or even a management team that are even open to, exploring this. And then the next step is you have to look at uh, the partnership. You had to interview them. You'll probably look at getting a market advisor, capital markets advisor. You'll get legal assistance. And I know that banks sometimes have tried to do it on their own, but if you don't structure the deal agreement in a way that's really quality, you can run into a lot of problems. You're going to get a letter of intention or, some kind of a legal document that says, okay, we're going to enter into this, we're going to be quiet about it, and you're going to start your due diligence. And so you're going to really want to do a deep dive. Both the acquirer of the bank they're acquiring and also the bank that's being acquired will want to look at what deal am I doing? Because if it's a stock for stock deal, you don't want to end up with shareholders, losing out and getting a worse stock. You don't want to have a deal going and find out that they can't pay. You don't want a deal that won't get approved by the regulators. For example, I saw banks that go in deep into the process of, a cannabis type of actual bank, and then only to find the regulators wouldn't approve it. So all those are important. You're going to do a fairness opinion to make sure that the shareholders are aware. But the biggest steps are not only with the regulators and the application process and all the discussions that takes place there, but first things first. Do you, as a CEO and the inner circle, agree this is the right deal for everybody? Is the board aligned? Does the board approve the deal? Next, the shareholder. Do you have a majority of shareholders that are going to approve the deal? It's like you don't walk into a room without knowing what a vote outcome will be. Just like you don't put this deal out to the shareholders without knowing that there's going to be, general reception. Then you got to put a notice in the paper. Polo was talking before about that rules by the regulators about, not having too many deposits in one area. You've got rules about, community reinvestment. So you have to put a notice out and you might get customer complaints. So there's a whole bunch of hurdles along the way. In addition to getting regulatory approval, usually at, state, federal, that could be SEC, could be OCC, Fed, if you're state charter, the state. So you have like all these different audience that you have to dance on a pin for. So, it's quite a heavy process, and that I think that's why now the deals take, a couple of years, and you really have to be committed to it. And it can, it can be a lot. I find it extremely exciting. Even when the deals fall apart, which they often do, it's still exciting to me.
Goodness, I likened it to a wedding. I only had to ask my wife's dad if it was okay to get married. Never mind 4,000 people around it. But yeah, the complexity is amazing. But again, so it should be, right? This is a highly regulated industry, and actually the provision of access to operate within it and within the controls for a customer, within the controls of the shareholders, like all of these things are critical to get right. I think what we'll do, we'll take a quick break here though. We're going to come back and deep dive a little bit more into the merger process, the challenges that banks actually might face in actually doing that. And of course, we chat about the most important person in all of this, the customer. It's all coming up after this super quick break. Don't go anywhere.
The time for community banks and credit unions to win is now. While the big players and exciting new challenges grab headlines, regional institutions are at the heart of the banking ecosystem, putting the service back into financial services. Serving their local communities, these organisations around the world have a unique advantage over their competitors. They have deep, established roots with their customers. They offer a local, personal service, and they're not tangled up in the legacy tech mess that the big banks are. To read, watch, and listen to what else we've got to say about them and how they can win, visit 11fs.com/communitybanks. That's 11fs.com/communitybanks.
Welcome back to Fintech Insider Insights. We're discussing today how to buy a bank. What are the main challenges then? So we sort of talked a little bit about that initiation phase, Virginia, akin to that first and second date, right? So, but bringing two banks together, particularly in the US, where we've got very different regulatory requirements across states. I mean, this is not just sort of a merger and it's done. Actually, suddenly you've got, two sets of parents to deal with, haven't you? I'm taking that dating metaphor far too far. I think I'm going to stop it at this stage.
Well, I mean, I think, it gets pretty complex. You have to make sure that you are, I think not tripping up like antitrust factors in terms of deposits and whatnot, but you also have to make sure that your merger is not harming the community in any way. You're not removing loan options. You have to make sure, well, I mean, obviously that the buyer is in solid shape, right? And can handle being a bank, but it's typically banks acquiring banks, so that's not usually a big hurdle. But you also have to make sure, I think, and this tripped up TD apparently when they try to buy First Horizon in Tennessee. I think the Wall Street Journal reported that TD had some questions from regulators relating to its money laundering practices, and that kind of thing can and apparently did scuttle that deal. So it's definitely not easy. You have to go through a bunch of steps, and I think the Biden administration is taking, kind of raising the bar. I don't know that they've kind of changed the policy formally all that much. They put out new guidance, and even the DOJ, which usually does not raise issues with deals, has said it's going to take a closer look at not what has traditionally been defined as antitrust issues, but kind of a deeper dive at products and potential concentrations in products, loan products, that kind of thing. So it's a tough process, and I think getting somewhat tougher. I think the bar is being raised clearly for the bigger deals, but I think what the banks struggle with is they know the bar is being raised, but they don't really know to what. So I think that kind of general uncertainty and not necessarily knowing whether a deal is going to happen maybe decreases some activity. I mean, the banks do check in with the regulators kind of informally, is my understanding, just to see like, hey, would this be totally off the table? And if they say no, then you're just not going to announce it. So you kind of have some sense of where regulators are going to go.
They just say it in a really abstract manner, like how my children talk to me. So just hypothetically, just saying, okay, if I was going to do this thing, would that be okay? Not us, but somebody like that type of way. Yeah, that does happen. I understand, but I guess, I mean, maybe on the customer side of things, with that respect, because we talk about banking like it's sort of a kind of an amorphous blob of organizations, but all around the world, every bank that is now massive, Chase or, HSBC or, whoever, started as a tiny little organization with a really sort of like specific purpose, and it's almost like what we're seeing with fintech now. Fintech is kind of focused on very small slices of communities or demographics, and they've sort of, HSBC and Chase got carried away over the last 200 years, and now they're huge, right? But is there a danger with these types of acquisitions that, particularly potentially, Virginia, with community banks that are a little bit more sort of purpose driven, is there a danger that they potentially sort of lose a little bit of that purpose or lose a little bit of that focus?
Well, it's interesting that you ask that. So you look at the customer, and you could broadly talk about a customer, but you really have to look and drill down. So, for example, in the community banks that I worked with in a rural community, you're going to have a different community customer base, and also you could have elderly folks, or the seniors, or sometimes lower income, that really want to walk into a branch. They really want that, face-to-face banking experience. And that's very costly. And you have to have brick and mortar, you have to have, tellers, you have to have, there's just a lot of different high costs related to the branch experience. But, for fintechs, they're looking at the electronics. It's a very powerful experience for the customer and the bank to scale up very quickly. So you look at some of the fintechs, and the world is changing, and younger customers don't necessarily want to go in a branch, and they want to do it on digital. They want it to be fast. They want it to be easy. And so you can scale up very, very quickly as a fintech. So it's a really funny thing, though, that the regulators still have regulations on the books that are set up like, where your deposits are, or, community reinvestment and stuff like that for the old traditional bank. Whereas a fintech, they're exploding, and they're matching the business plan to where they see the future of financial services to be. That's not true in every case. You saw, I think Chase was starting to open up branches. I heard of a concept the other day called a global banker. And I'm like, what is that? I had never heard of it. So a global banker is someone that anyone could contact and pretty much pay a fee, and they do all your banking for you. So it's highly transactional. They're going to put your funds in whoever has the highest rate and yank them out real quickly. And I said, well, geez, that's like a glorified teller. It is a global banker. And you see some young people that maybe don't want to walk in a branch because they're either intimidated or don't like it, but they still need hand holding because they don't know exactly what to do with their money or how to set it up. So there's a whole different customer base, and community banks used to be successful in having a niche or a community that they serve, and it's just it most of the time is not cost effective anymore unless you're a CDFI, low income. uh, Sometimes you get grant and capital relief because you're catering towards low income or a certain minority. So there's all different exceptions to the rule, but generally you could scale up much faster and are more efficient as a fintech.
Yeah, I mean, it's an interesting challenge, isn't it? We sort of make the argument that not all the things that we use are necessarily good for us. I mean, look at fast food, right? It's like, yeah, super convenient, not great for my cholesterol levels. Like so like the idea that financial services is sort of moved to this self-service positioning is really not great for a lot of people, because at the same time around the world we've got financial education at the all-time lowest level. So like the idea that an app and me picking from a list of things what I should do, the idea of that, what sounds like a sort of a private banker in your pocket, that sounds like a good idea. But essentially you've got to sign away almost power of attorney for that person to make decisions on your behalf and move money around. But it is an interesting point that you make on the regulation being fit to essentially the more of the physical setup in terms of branches and property and people and all of those things that come with it. Whereas obviously as you say, in a digital world, then the operations should scale in a way that doesn't necessarily reflect the way in the regulation. But I guess sticking with customers though, the point that you were making there about ensuring that the consumer essentially is protected and benefits from these types of mergers. How much does the regulator look at that then, Virginia?
Uh, well, the regulators have compliance rules and regulations, and you're talking about, dancing to two different regulators, the state and federal, but it's actually usually a lot more. You've got, in the United States anyway, you've got the state, you've got the federal, your primary regulator, which is probably the OCC, FDIC, or Fed. You've got now the CFPB coming in. You've got the SEC. You've got then you've got your auditors, internal auditors. I mean, there's just a lot of eyes overseeing the process. So all of those are involved in a merger acquisition. So I not all of those, but depending on the case, they could be, I should say. So they're all also looking out for the customer. So you're looking to be able to demonstrate that you're serving in a manner that fits with the compliance rules, which include Bank Secrecy Act, privacy. In the state of California, you've got like these really rigorous privacy rules. You've got, you have to know your customer. If you're electronic, how you're going to set it up so that you meet the traditional, face to face. How am I gonna set it up? Just stupid things like, well, not stupid, but for a long time the regulators wouldn't accept an e-signature. So how do you do that? So the actually knowing your customer base, treating them fairly, all of that is part of the process of a merger. So that's on the end of getting acceptance by the community and by the regulator. But also you have to look at where do you make a buck, and how do you serve that customer base that will be willing to trade a service for a cost. And that's being heavily regulated now. So you see in the United States, I don't know if you've noticed, but the fee structure is being very heavily regulated. We're being very criticized, and we're limited on the amount of fees we can charge. And, if someone goes over or, doesn't pay timely or doesn't make their payments, or credit card fees, all of that is subject to a lot more regulatory structure and scrutiny. And the fee structure is really, you have to swallow whatever the regulators say. So it's a whole different world, and it's changing quickly.
Hence why big banks have so many people working in compliance and regulations and all of these things as well. It paralyzes many organizations, doesn't it, as well, in terms of just the sheer number of people. But Polo, I guess touching on those points when it comes to, the impact on consumers, and brand is always a consideration here as well. You could go through this whole process and then end up without even changing banking with another brand, which is a bit of a weird experience for people, right? All these things need to be considered, don't they? Because again, the ROI is based on you retaining these customers you acquire, right?
Yeah, certainly. And I think one critical point of that as well is like, even if you're a big bank just doing the basic stuff, right? I think we're talking a lot about kind of the approval process and whether regulators might sign off on a merger if they deem it doesn't harm the community or even benefits it. But, I think after a merger, and I don't have hands-on experience here, but like, a lot of things need to happen. You need to, you've got customers at one bank and at another bank, and then you have to figure out, okay, well, which app are we going to use, or which, digital service are we going to use? And, you have to migrate one to the other. And, I think we've seen, well, one of the bigger bank mergers, Truist, in the kind of southeast and east coast of the US, they merged in a pretty big deal, I think, in 2018. And, they didn't do some of that basic blocking and tackling quite right. And, I think customers were frustrated. I think we and others have reported on that. And, I think this is kind of a thing that you saw, I think in the 80s and 90s, when, there was this kind of start of consolidation in the bank industry, you just did not really merge the systems as well as you could have. And, it's still to a certain extent a problem. And, and I think that can really throw off, the rationale for a deal, because if, you make your customers angry and then they go to a bigger bank, then, maybe it was all for nothing.
It's funny that point on the technology part's never been really integrated. The amount of banks that we work with, and it's like sedimentary rock. You sort of see the layers and the layers of stuff that's built on and built on and built on, all the way back to the sort of mainframe COBOL stuff. And it's the ROI was based on, hey, we were both doing these things, we should consolidate, but often that just doesn't happen. But I guess sort of this all sounds sort of quite scary, and I guess again, it's scary for a reason, right? And again, I come back to being a bank is like quite a serious thing. Like the regulators don't give out charters to anybody. It's not like 6 Kellogg's boxes and you get their free banking charter, right? So there's many instances of this going pretty wrong, right? Do you guys want to mention? I mean, I can mention a few, but do you guys want to mention any particular ones that you've seen that actually probably they didn't really pan out in the way that they thought they would?
Well, I like to just respond to that in general, because I've seen a lot of bank mergers gone bad in the years that I've been around, and there's usually a theme of why they went wrong. For many of them, there was no integration plan. So you do an acquisition, and it just doesn't stop on the day that you announce your full new charter. You have to have an integration plan. You have to have a business plan, a strategic plan that you stick to, or kind of change for a reason. But there's a nuance to it that you almost can't put in writing, where you're looking at usually a combined management team and combining cultures And it really takes a finesse. I happen to just love it. I thrive on it because it's really putting two different bodies together and really trying to see how they can work. And it's a different dance and a different negotiation. So it's almost like a country taking over a country, and with two different cultures, and then being respectful of the way the different cultures work. It doesn't always work that well. So there's a couple of reasons why I think it doesn't work. One is no integration plan. Another thing is egos. So people come in, the management team, they think they do it the right way or the best way. That could be even at mid-management. They're unwilling to change or learn, and things go haywire. You have to be in touch with your customer base and make sure that you're serving them and also the new shareholder. So there's so many different stakeholders. I will say that with fintechs buying banks, you really have to have a reality check on compliance, and also not not have a little humility, even a bigger bank buying a smaller bank. I can say this as a small-time community banker, and you may not agree with me, but I think there's a lot of value with these small-time bankers. As a community banker, you wear every hat. I have done a lot of merger and acquisitions kind of in the same manner as some of these large multi-billion dollar bank deals. And I have a wealth of knowledge. And sometimes that's poo-pooed because A, you don't have the technology experience, you don't have all the big mega bank name title or come from an Ivy League school. So I think really just putting your ego aside, looking at who has the strengths, how do we merge them, and how do we serve our customers in the best way? And let's move forward in a mode of harmony. It sounds kind of spiritual, but it's really true. It's like, how do we all get along and make this the best new organization that we can?
Yeah, I think that's a really good point, and one that, as a reporter, it's just hard for me to like discern that, right? Because I don't work at a bank, and so I don't like, you just see a deal happen, and you assume that, sure, they're smart business people, they'll figure it out. But that kind of culture stuff, it really does matter in ways that, I think Virginia spoke to quite well, because it's also think about, just a workplace with a different culture than you'd like, or even just, you don't know, right? In this merger process, you're an employee, and, you want to make loans, but, you're just kind of in this uncertain period while there's shareholder approval or there's regulatory approval. So I think it's also a challenge to kind of keep employees happy, because, I think during the time that banks merge, it's kind of other competing banks in the area can pick off employees, and so again, to get the adequate return on the investment, you have to hang on to your loan production folks, and you have to keep folks happy, and I mean, I think that's just some intangible leadership challenges that I think banks really have to sort through, and they talk about it on earnings calls. They talk about the culture is a good fit, and whatnot, and and yeah, I think that's just a critical part of the process, and one that is not last for more than a year or two, right, as the kind of integration process happens.
Yeah. I mean, it's an interesting point, isn't it? I'd say it's often forgotten what you're saying there, which is, these might be businesses, but every business is just a collection of people. And actually, I mean, it's like organ transplant, isn't it? Does the organ reject the host, or does the host reject the organ? I mean, it can be 50-50, but either way, it's a bad outcome, isn't it, in terms of the way in which that pans out. So that sort of merging of the people in that process, the cultures, the rituals, the rhythms, the sort of belief systems, I mean, that has to be as much about to your point, Polo, in terms of the due diligence that is done at the beginning of those things, because many cultures won't mix particularly effectively. So is that, do you think, is that maybe the real ROI that you want to see from this? Is that maybe the real way we would measure success? Is that the right customers and the right talent remains post-merger? Maybe starting with you, Virginia.
Well, of course, you want to see the ROI increase, or you want to see a long-term plan and patience is always golden. So in the long term, you want to see a return. And I think realistic goalposts and success to me is measured by the shareholder, the ownership value. So of course you want to see ROI as as one of the goals of the new organization. You also want to see customer satisfaction, and you want to see how you serve the community. I mean, I think you're in banking because you want the ROI and you want to make money, but there's also, I think, a real, it's sort of a community spirit, which you do want to serve your customer. You want to make things right, and you want to see it last over the long term. And I think that's the value proposition. So ROI, like you say, is very important.
100%. They call it financial services for a reason, right? The serving the customer bit is pretty important. Polo, what do you think? How do we really measure then the success of a merger?
Yeah, no, I think the points Virginia made are great. I also think it takes some time, but I think once you have challenging times and a bad cycle, it's how much money do you not lose, right? And sometimes with mergers, this is also part of the culture side is one bank might take more risks than another, and so if you are able to kind of integrate the banks and kind of keep a somewhat conservative underwriting, right? Return on investment also means don't lose your investment when times are tough, and so to the extent that you can kind of keep the right controls there, I think it's critical. And I mean, and that's the kind of thing that right now I think is we've talked a lot about the regulatory picture and regulators getting somewhat tougher on banks, but I think the banks don't really want to merge right now as much because high interest rates are making their businesses somewhat difficult, but also they don't really know, they trust the health of their loan portfolios, and they trust that, yes, my loan to this, suburban office building is good, but how can you trust that the other bank's loans are good? I mean, there's numbers and stuff, right? But, I think it's that kind of, thing that, I think banks are finding a little bit tricky right now is, you don't necessarily want to merge because, this is a time to kind of hunker down if we do get some sort of, high rate recession or whatever. That's the kind of stuff that can, frankly, wipe out bank equity in the worst of times. So,
well, and that's why I think the world is sort of different than it was. Mid 90s with crazy sort of NatWest buying ABN AMRO and the world imploding, and actually it's very different, isn't it? The people who are acquiring the risk in the market is very, very different. I think actually the market sort of corrections that we've seen around valuations and structures and and these things called interest rates being a thing again, it's all changing the market, isn't it? But I think we could probably talk about this for like several more hours, but I think we sort of conclude that there's a lot of paperwork. There's a lot of process. It sounds like there needs to be a hell of a lot of patience as well to kind of, deal with that structure and everything that goes. It isn't a short-term thing. It's definitely not a weekend fling, Virginia, to keep, keeping this metaphor going. It's a long-term relationship that people have to sort of build on those things. But I think what we'll do, we're going to stop here and then let the rest of the team unpack this a little bit more in the next episode. So we're going to have to wrap up the discussion. Next week, though, my colleague Kate Moody and Dave Morris are going to be picking up where we left off. In part 2, what they're going to be doing is chatting a little bit more about really what happens internally during a merger. Dave particularly has got some really great experiences being inside one of those organizations when that's going on, and the impact that has on the systems, the process, and the people, as we've discussed as well. So at that point, we're going to have to wrap up. So thank you so much for joining me. Where can people learn a little bit more about you? Virginia, starting with you.
Okay, well, it's been an honor to speak with all of you today. All my discussion items have to do with my opinions, and I represent myself, not any of the agencies I work for or my employers. I can be reached on LinkedIn. Again, my name is Virginia Varela. My email is vavadvisory, which is the name of my consulting firm, vavadvisory@gmail.com. Well, it's not a consulting firm, but soon to be.
Very good. You heard it here first, folks. Polo, where can people learn a little bit more about you and all the good work that you do at American Banker?
So AmericanBanker.com, we've got a great team of reporters that, post stories daily on a bunch of issues. So definitely check that out. You can find me on LinkedIn as well, if you've got questions or complaints or any of that kind of thing. But yeah, AmericanBanker.com, we've covered the industry in and out.
Very good, very good. As for me, you can find me lurking on LinkedIn. It's where I spend most of my time these days, I have to say, with this social media of choice. Thank you so much for listening, everybody. If you do like what you've heard, then follow the podcast and don't forget to leave us a review. It super helps us make it better and helps other people find the show as well. As always, if you want to join the conversation, you can find us on all social media channels. Just search for 11FS or Fintech Insider, or email us on podcasts@11fs.com. Thank you very much for listening, everybody. Goodbye.
The time for community banks and credit unions to win is now. While the big players and exciting new challenges grab headlines, regional institutions are at the heart of the banking ecosystem, putting the service back into financial services. Serving their local communities, these organisations around the world have a unique advantage over their competitors. They have deep, established roots with their customers. They offer a local, personal service, and they're not tangled up in the legacy tech mess that the big banks are. To read, watch, and listen to what else we've got to say about them and how they can win, visit 11fs.com/communitybanks. That's 11fs.com/communitybanks.